All right, let's talk about Lovesac. On December 11th, the company dropped its third quarter earnings, and well, the market's reaction was not good. It was swift and it was pretty severe. So we're going to break down what happened, why it all went down, and what management's new game plan is to navigate what's looking like a very tricky environment for consumers.
And when I say severe, I mean a 14% drop in the stock during pre-market trading, right after the numbers hit the wires. So, the big question is, what on earth happened to spook investors that badly? Well, the story really starts with a classic headline miss. The negative reaction was pretty much a direct result of them falling short on both the big numbers, revenue and earnings, and failing to meet what Wall Street was expecting. Okay, let's get into the nitty-gritty. The earnings per share loss was 72 cents, just a couple of pennies worse than expected. Not the end of the world. But revenue, that came in at $150.2 million, a full $4 million shy of the consensus. But honestly, the real kicker, the number that tells the story of the pressure they're under, is that adjusted EBITDA. It swung from a positive $2.7 million last year all the way to a negative $6 million this quarter. That is a huge hit to profitability. So what was the excuse? Well, management was pretty direct about it. CEO Sean Nelson pointed the finger straight at a tough economy. He talked about meaningful choppiness, especially for their lower-priced items, stuff under $6,000. In their view, this wasn't really about them messing up. It was an "it's not us, it's the economy" kind of problem. And it's one thing to miss Wall Street's numbers, but it's another thing entirely to miss your own forecast. That $150 million in sales wasn't just $4 million below the street. It was also about $1 million below their own guidance. And that right there is a detail that investors really, really don't like to see. And if we dig just a little deeper, the pain just keeps on coming, especially with profitability. Gross margin fell by 240 basis points compared to last year. Management basically said it was a triple whammy of higher tariffs, rising shipping costs, and having to run a lot more promotions and sales just to get people in the door. Okay, so the quarter was bad. We get it. And at that point, the earnings call totally shifted gears. It went from here's what went wrong to here's our brand new game plan, because they see this downturn lasting for a while. Right, so what do you do when the entire market for your product is just weak? You can't just hope for a rising tide to lift your boat. This was the question they had to answer, and boy, did their response signal a major, major change in priorities. So here's the new playbook, and it has 4 key moves. First up, they're delaying that big, much-anticipated new room product launch. Second, they're slamming the brakes on opening new showrooms. Third, they're going all in on what they're already known for. They're sectionals with this new mantra of winning the living room. And finally, a massive, massive operational shift toward making their stuff right here in the US. Now, putting some dates to this really shows you how big of a shift this is. The domestic manufacturing starts up next summer, which is great, and this is the real headline for growth investors. That huge new room launch, it's now pushed way, way back to early 2027. And look at this, just 10 net new showrooms planned for next fiscal year. That is a serious slowdown. And this quote from the call, it just perfectly captures the whole new philosophy. Forget about conquering new worlds for now. The plan is to harvest the brand, which is really just a fancy way of saying, let's make more money from what we're already good at and defend our turf. So with this new, more focused plan in place, what does the future look like according to them? Well, even though they had a pretty decent Black Friday and Cyber Monday, the overall tone for their forecast was, let's just say, extremely cautious. For the full fiscal year, they're looking at sales in the ballpark of $685 to $705 million, with adjusted EBITDA somewhere between $37 and $43 million. What this really means is they're planning for just a little bit of growth. They think they can keep stealing market share, but they're doing it in a furniture category that's actually shrinking overall. And they were really clear about why they're being so careful. They literally said they're maintaining an abundance of caution. In other words, they are not counting on any help from the economy to hit their numbers. They're telling investors to expect things to stay choppy for a while. All right, let's tie all of this together. We've got the bad results, the big strategy shift, and the super cautious outlook. So what's our final call on Lovesac stock as we head into the next few quarters? We're rating this one a market perform, and here's why. We think the stock is probably going to move in line with the broader market.
It's a classic good news, bad news story, where the interesting things the company is doing are basically canceled out by the terrible economic backdrop.
It really is a tug of war. On the one hand, the bulls will tell you Lovesac is a winner in a tough category, and this whole domestic manufacturing thing could be amazing for their profits long term. But on the other hand, the bears will fire back that margins are getting squeezed, the consumer is weak, and their biggest growth story just got delayed by over a year. That perfect balance is what leads us straight to market perform. Now, before we wrap up, let's do something a little fun. We're going to put on our hedge fund analyst hats for a second and pitch a slightly outrageous but totally plausible trade idea based on everything we've just talked about. The idea is a Paris trade. You go long Lovesac stock, but at the very same time, you go short the entire retail sector using an ETF like XRT. So what's the logic? Well, you're trying to isolate the Lovesac specific story. You're basically betting that their strategic plan, the US manufacturing, focusing on the living room, is going to work better than the average retailer's plan. This way, if all of retail goes down, your short position helps protect you. But if Lovesac's execution really shines, your long position should win out. It's a pure bet on their strategy hedged against the wider economy. And of course, the big mandatory disclaimer, this is absolutely not financial advice. It's just an analytical exercise, a thought experiment to explore the themes from the call. Please always, always do your own research before making any investment decisions.